Welcome back to the T3 Trading Edge short course. This is the third video in the series. Conceptually, the T3 Trading Edge consists of three separate trading edges that are superimposed on each other. This video discusses trend, which is the first core element of the T3 Trading Edge. No doubt we all know the phrase, "let the trend be a friend until the bend in the end." On a chart, an uptrend sees price move higher, making higher highs and higher lows, and a downtrend sees price making lower highs and lower lows. Market wisdom says to favor trade in the direction of the trend. In an uptrend, buying is stronger than selling, so we only want to be buying. Similarly, we only want to be sellers in a downtrend. Trading with the trend is a trading edge because the underlying causative factor is that you are aligned with the dominant market force at that point in time. You are a buyer when the dominant force is buying, and a seller when the dominant force is selling. The expected benefits of trading with the trend are smaller risk, larger reward, higher odds of winning, plus a trade that is likely to move faster and more directly to your target. For the last two items, once we enter a trade, our preference should always be for price to quickly move away and not look back. Now I know what you are likely thinking. Trade with the trend is hardly earth-shattering. All traders know the concept. But here's the rub. Traders, especially new traders, habitually trade against the trend. Oliver Velez attributes 85% of all trader losses to counter-trend trading. I don't know how accurate his number is, but I suspect there's more truth to it than not. Basic trend videos are a dime a dozen. I think it is better use of our time to spend the rest of this video exploring different ways as to why we find ourselves counter-trend trading and what we can do about it. In tandem with our trend discussion, I need to include discussion of trading ranges. While the market wisdom says trade with the trend, it says to do the opposite for trading ranges by fading new highs or new lows. Another way to express the trading range rule is that most breakouts fail. Both the trend and trading range rules align us with the dominant market forces at that point in time, so are causative. From my experience, here are 4 ways traders can find themselves trading backwards to the market. 1. Entering too early on a retracement, only to see price retrace more deeply, stopping out the trade, before reversing to resume the trend. Videos 4 onward in the series should help with this issue. Here's an example showing that waiting for the retest of the prior swing low was better than the earlier retest of the moving average. 2. Some traders jump the gun. Typically, for example, in an uptrend, you will see multiple shorting attempts on the way up, resulting in some minor retracements that quickly reverse as the uptrend resumes. In this scenario, conceptually, some traders will have had limit orders set to sell once price gets to their supply zone or some other key reference. Other traders might then get short, using stop orders as soon as they see something bearish looking in the last few candlesticks on the lower time frame. But a couple bearish bars is usually not sufficient to reverse the trend. So these counter-trend trades typically fail because they are low probability trades. On this chart, you can see several failed attempts to reverse the trend just below and then just above the references shown. I would also invite you to consider the following hypothesis. The various algos used by the different institutions buy so they can sell, and sell so they can buy at certain areas as price progresses up or down, leaving them with the need to reconcile position when price returns to each area. So if an algo bought, say, 10,000 contracts to sell 50,000 contracts higher, dropping price for a swing down, then when price returns back up to the origin of the buying, the algo will sell 10,000 contracts to close out those initial longs. So if I see a couple bearish candlesticks with this concept, I first think algo housekeeping in an uptrend, not trend reversal. To be fair, this might be a false narrative, but it is one that I found helps temper impulsiveness. 3. While trend has a clear definition, it seems that trend reversal does not. I never truly appreciated this gray area of trading until I started making this video. I searched dozens of sources and found no consensus definition for a trend reversal. Traders use a variety of different ways to define a trend reversal, including structure, trend lines, moving averages, and indicators like RSI. The clearest definition to me is a break and hold inside the market structure of the same time frame. So for an uptrend, ideally there is a break of the higher low before the last higher high was made, usually with a retest of the high, followed by a move and staying below the higher low reference. However, here is a tidbit that I bet many traders do not appreciate. Traders usually define a potential trend reversal, keyword here being potential. This means traders typically look to enter early before the trend reversal has actually been confirmed. To further complicate matters, trend reversals come in all shapes and sizes and do not conform to any one pattern or sequence of steps each and every time. It is also not uncommon that a trend can reverse and then immediately reverse back again. Spotting potential trend reversals is therefore not straightforward, but rather subjective. As a result, many potential reversals will likely fail to play out. The reasonable takeaway is that trading trend reversals is a lower probability trade. Traders should either appropriately manage their risk-to-reward ratio or avoid the trade altogether. Fourth and last, many traders focus too narrowly on the lower time frame chart, and some even go so far as to focus solely on the last swing or even just the last few bars that printed on the lower time frame chart. While it is good to have a simple mechanical trading system to follow, there is a point where oversimplification can hurt your trading. I favor the multi-time frame approach that has you enter in the direction of the higher time frame trend when an intermediate time frame retracement reaches a key area, and then you use your lower time frame chart to refine and trigger your entry. In this way, I am trading consistent with the higher time frame trend, which means I'm trading in the same direction as the dominant institutional traders. In contrast, if I were to just trade with the trend of the last lower time frame swing, I would not know if I was trading with or against the dominant institutional traders and at what price they are interested in potentially reversing the market. Using the multi-time frame approach, I can still trade the lower time frame long, consistent with an intermediate time frame rally up, in the context of a daily downtrend. But in doing so, I am aware that I want to be long low and early in the intermediate time frame swing up, and want to be looking to exit up where I anticipate the intermediate time frame uptrend will end and the daily downtrend will resume. A key benefit of being aware of the higher time frame is looking for price to go down on a lower time frame so that it can go up, usually sharply, on a higher time frame. Whereas the strictly lower time frame trader will tend to be confused looking for the downtrend to continue lower. Given these 4 points, I hope you agree with me that a trader is likely to be in for a world of hurt if they don't know which is the dominant direction of trade, where it is safer to enter a trade, and where a trade may reverse, what constitutes a trend reversal, or how appropriately to manage the trading of anticipated trend reversals. The traders I respect the most can look at a chart like that for March 1st and immediately spot the daily bias short from the overnight high, targeting the 2 previous daily lows, then be looking for and allow any price rally up as a way to get short 1 or more times that day until the target was hit. When it comes to trends and trend reversals, I think Tradingpedia did as good a job as anyone in their descriptions. Of note is their description of a potential trend reversal occurring after the trend line is broken, followed by an attempt to retest the trend extreme. I encourage you to review their website at your leisure. Please remember that trade is two-sided, so while a downtrend may attempt to reverse after seeing buying interest strong enough to break the downtrend line, there are sellers waiting for that break to sell short. A break of a trend line is not sufficient to reverse one's bias because the outcome is uncertain. For myself, I do not look for a one-size-fits-all trend reversal pattern. Also, after spotting what might be a reversal, I remain open to all possible outcomes, ranging from the reversal playing out, to alternatives like the reversal failing, conversion to a trading range, or the trend direction flipping rapidly 2 or more times, or just getting a sloppy, choppy mess. If I am confused, I sit it out because it is otherwise an easy way to have multiple losing trades in rapid succession. Sometimes I draw a trend line to assess trend. Enough traders will be looking for the trend line break retest of the extreme sequence that it is worth being aware of that sequence and the two-sided opportunities. However, I mostly look at just the candlesticks and look for a break of the market structure. Ideally, the break will show some conviction behind it, so not just a break with a wick by a couple ticks, but rather something with closes by a few points below the structural high or low. Now I am alerted to a potential trend reversal, so we'll look for a low-risk entry on the retest of the prior extreme. The key aspect of this lower timeframe reversal and entry sequence, however, is that the location is consistent with price reversing on at least the intermediate timeframe and preferably also the higher timeframe. What I doubt you will find discussed anywhere are the non-ideal trend reversal situations. One must be careful not to confuse the highs and lows on the lower timeframe with the intermediate timeframe, such that, for example, lower highs and lower lows on the lower timeframe are thought to represent a trend reversal on the intermediate timeframe. Now how about when the last swing up in an uptrend forms a trend line steeper than the trend channel, and the trend line breaks well before the trend channel's lower trend line is broken? What does it mean if you get a structure break without a trend line break, or vice versa? How do you handle parabolic moves that shoot straight up and then come straight down, or strong uptrend that converts to a sideways trading range resembling a flag pattern? Lastly, what if the intermediate timeframe trend reverses before hitting the higher timeframe target? There is a myriad of scenarios a trader should be prepared to encounter. My opinion is that assuming all uptrends reverse when the trend line breaks and then forms a higher high is a naive oversimplification of trading that should be avoided. To me, it suggests another false narrative. When it comes to trend trading, I like to group traders into two main camps of approach. First, we have trend traders who specialize in trading the middle of trends and tend to lean towards scalping, single time frame focus, using trend lines and moving averages, and a forward-biased momentum price action assessment. The second camp I will lump together and loosely call swing traders, who specialize in market reversals and lean towards larger trades, multi-time frame analysis, no secondary tools, and a retracement-based price assessment. What the two camps look at and how they assess price action are quite different and often oppose each other. Trend traders on the lower time frames should therefore expect swing traders to be waiting to oppose their trades at the intermediate time frame references. Both camps will have days where trade setups are absent or poor. On those days, it is quite likely the other camp has interim control of the market. With these two trader camps in mind, let's now consider those trend traders that swear by trading at their moving averages and trend lines as the very best places to enter trades. I would suggest to you that it is unlikely that the various algos controlling price movement require or are leaning against trend lines or moving averages. Algos have no eyes, so have no need for visual aids. I would also point out that many trading methods do not use trend lines or moving averages, and that trend lines and moving averages are subjective, tied to your individual biases and your particular chart bar type and bar period. Lastly, trend lines and moving averages are a derivative of price, so a tool that is secondary to reading price action from the candlesticks themselves. This suggests that trend lines and moving averages are not causative, at least not on day trading timeframes. When I watch trading videos, very often I see the person adjusting their trend lines to fit price in hindsight, tweaking the trend line to go through wicks or bodies to better fit how price reacted. That's cheating, so all that hindsight stuff has to be thrown out. Using swing trader methods of price action analysis of candlesticks, I can explain how an uptrend forms its sequence of higher lows without use of trend lines. So to me, trend lines are not necessary, so cannot be causative. However, at the same time, I can't explain how trend lines have a canny ability to suggest where price retracements end some of the time. I can also lay out a similar line of reasoning for moving averages. So while I conclude neither are causative on day trading timeframes, I cannot dismiss use of either entirely. I can, however, when trading, consider both and look for retracements to end where my horizontal and inclined references intersect, because that is a point where the two different camps of trader thinking are in agreement. So let's dive into some examples now. First, let's consider how a trader can get turned around during a pullback in an uptrend. Some traders favor two-legged pullbacks like this before entering a retracement. So as trend traders, we have a trend and are using a trend continuation method to find our entry. It should be a no-brainer that we are only looking to go long, right? However, add a moving average or trend line on the retracement and observe that it is pointing down, so some traders will incorrectly start shorting. The recency bias has the trader so focused on the downsloping moving average and minor trend line on their lower time frame chart that the trader not only gets backwards to the market, but also backwards to their trading method and own thinking just a few minutes prior. This trader suffers from short-sightedness and has confused their time frames. At the end of the day, if you look back at your identified trade opportunities and see a pattern of alternating long-short markings, then you likely fell victim to this issue, and we're not looking to trade consistent with the intermediate time frame or higher time frame trends. Here is an example daily summary of trade opportunities. I can only speak for myself, and I know that I can't flip back and forth between long and short, and some of these trades are directly into the opposing trader camp. My preference is to identify the 3 to 4 good trades and ignore the rest of the 30 entries identified. Here's a strong swing down that just breaks below a trading range. To some, that strong swing represents a downtrend, so traders will look for a short entry for trend continuation lower. These traders had been thinking trading range, but the strong swing down flipped their thinking from range to trend, and thus from taking longs to shorting. Most breakouts fail, so the short trade is usually a losing trade. We can take this last example one step further. When you first fire up your charts in the morning, let's say you see the overnight price action was straight up dozens of points and has now stalled as we head into the open. How might you trade the upcoming session? What is your bias, and what is likely to be the best low-risk entry for the day? Did you anticipate a flag pattern consisting of the impulse up and sideways ranging? Will you be patiently waiting to see if we get a failed breakout below the range low for the long entry opportunity so that you can likely hold into the session close? Here we can combine trend, trading range, and the higher time frame context to formulate a plan before the market even opens. If instead you are stuck mired in the lower time frame, you likely went back and forth between long and shorts, likely break even at best, and quite likely got yourself so distracted or worn out that you missed the trade of the day. The last two examples involve stop hunts. A break outside the prior range highs or lows to trigger accumulated stops, followed by price reversal. Stop hunts are a great way to confuse trend traders, especially those that overly focused on the lower time frame charts, leaving them wondering what just happened and trading backwards to the market looking for trend continuation in the direction of the stop hunt. Frequently, the market will open with a stop hunt to get traders trading backwards to the market. This can be a small pop just outside the overnight high or low, followed by a strong reversal, or in an existing trend, a rather strong-looking pullback, 1 or 2 even swings, to trigger trailing stops before reversing strongly to continue the trend. Like traps, this market head fake is effective at confusing retail traders. In a trend, the break of a trend line or market structure is a form of stop hunt, targeting traders that trail their stops as the trend progresses. Going forward, learning to recognize and even anticipate the stop hunts is likely to help a trader stay on the right side of the market. Hopefully, you will see we have come a long way from our starting simplistic trend and trading range diagrams. We have explored a number of different ways to improve trading with the trend and trading range rules. In summary, trend is the first core element of the T3 trading edge. Favor trade in the direction of the trend to trade consistent with the dominant market force at that point in time. Be aware what is happening on the intermediate time frame and higher time frames, because these time frames determine where lower time frame trends will end. Learn to recognize stop hunts for what they are and not look to trade them as if they were trends. Be mindful of the use of trend lines and moving averages as secondary tools, and remain aware of their limitations and potential to distract you from reading price action. Thanks for watching. I hope you found this video helpful. I look forward to seeing you in the next video, where we look to integrate the higher time frames more into the T3 trading edge.